September 1929. Manhattan hums with traffic and optimism, but a thin layer of unease hangs over the city. In a corner office, a middle-aged businessman stares out at a skyline built on credit and faith in a new era. The newspapers talk about permanent prosperity, radio hosts celebrate soaring stock prices, and doubt feels unreasonable. Yet, somewhere in his gut, something feels wrong. He cannot see every bank's books, but he can feel the pressure building, like heavy air before a storm. On a gray Tuesday morning, he decides to listen to that feeling. He walks into his local bank, the kind where the teller knows his name, places his worn passbook on the counter, and quietly asks for everything, every dollar. The clerk glances at the balance, hesitates, then opens the drawer and begins to count. $12,000 in cash, the savings of a lifetime, are stacked, wrapped, and placed into a leather briefcase. Within an hour, the man steps back onto the sidewalk with his entire financial life in his hand. 2 days later, the world he just walked out of begins to implode. By Thursday, the market collapses with violence. Ticker tapes run red, fortunes vanish in hours, and the roaring Twenties slam into a wall of margin calls and forced liquidations. Across the country, banks begin to fail as frightened depositors form lines that curl around city blocks, staring at locked doors and closed signs. For millions, it is already too late. But for that one man with the briefcase, the story is different. His bank may fail, his broker may go under, his city may descend into chaos, but his cash is in his possession. He has options. He can leave, he can wait, he can survive. Now move the story forward almost a century. Imagine it is early 2026, and you feel a similar pressure building. You may not understand every derivative or bond market detail, but you can sense that something is off. Prices look unmoored from reality, and the calm feels artificial. You decide to do what that 1929 businessman did, get out before the stampede. But you no longer walk into a branch. You open a browser. Your 401k balance glows on the screen, $180,000. Built over 20 years of work. You look for the exit button, withdraw, distribute, move to cash. You are not asking for a favor. You are asking for what is supposed to be yours. You click, expecting the modern version of a teller counting bills. Instead, a different kind of screen appears, a penalty calculator, federal tax, state tax, early withdrawal penalty for touching your savings before age 59 and a half. Line after line, quietly shaving off pieces of the number you thought you owned. By the time the deductions stop, your $180,000 have shrunk toward $100,000 on paper before you have seen a single dollar in your hand. And then comes the part that would have been unthinkable to our 1929 businessman. You discover that even this reduced amount is not waiting for you. Your request is not a demand, it is a ticket. It drops into a processing queue with a polite estimate, 7 to 10 business days under normal conditions. That small phrase, under normal conditions, does more work than any marketing brochure, because crashes are, by definition, not normal. In calm markets, back-office systems can take their time. In panic, they choke, and administrators can legally delay or suspend distributions. You may never have read those clauses, but your money is trapped inside them. The very moment your survival instinct tells you to move quickly is the exact moment when the architecture around your savings is designed to slow you down or stop you altogether. Not because there is no money anywhere, but because the modern system treats your attempt to exit as a threat to its own stability. In 1929, a bank run drained the vault. Today, the system tries to prevent the run by controlling your ability to act. This is the unnerving difference between 1929 and 2026 that almost no one talks about. Back then, the disaster was speculation, leverage, and debt built on top of an economy that believed nothing could go wrong. Today, we have speculation, leverage, and debt again, but layered on a different foundation: digital cages. In 1929, the trap was psychological. Most people stayed in because they believed the good times would continue. The exits were still physically open for those few who saw the danger early enough. In 2026, the trap is structural. The exits themselves are wired with delays, penalties, and switches that flip precisely when too many people try to leave at once. Your accounts feel like ownership, but they function like permission. Your savings are technically yours, yet they are accessible only on terms written by someone else, enforced by software you do not control, inside a legal framework designed to prevent you from acting too quickly. Every mechanism that slows you down, the 10% penalty, the tax bite, the suspicious activity review if you move too much too fast, the processing delays that stretch from days to weeks, is marketed as protection. Protection against volatility, protection against fraud, protection against your own supposed short-sightedness. But protection for whom? The businessman in 1929 survived because, for all its recklessness, the system still allowed an individual to walk in, take his money, and leave before the mob understood what was happening. He was early and he was lucky, but he was not blocked. Today, the average saver could be months earlier than the crowd and still not get out in time, because the crowd is no longer the only obstacle. The plumbing itself is hostile to rapid exit. Digital rails move numbers at the speed of light, but the human being trying to convert those numbers into usable cash is forced to move at the speed of forms, reviews, and policies that did not exist in his grandfather's world. That is why casual comparisons between the next crash and 1929 miss the most chilling detail. It is not just that another collapse may be coming. It is that we have quietly removed the one advantage ordinary people once had: the ability to move their savings out of the blast zone before impact. The 1929 crash was devastating because so few saw it coming. A 2026 crash, if it unfolds along the fault lines already visible, will threaten even many who do see it coming, because when they finally decide to act, they will discover they are not holding their wealth at all. They are holding a claim that can be slowed, clipped, or denied. To see how we ended up here, in a world where the illusion of access has replaced the reality of it, we have to go back and examine what existed before the gates were built. Back to the age of passbooks and paper stock certificates, when money moved at human speed, and when the system did not yet have the power to keep you inside when you decided it was time to run. Walk back into that pre-digital world for a moment. In 1929, your relationship with money was almost painfully simple. You earned it, deposited it, and if you wanted it back, you went to the same building where you'd shaken hands with the manager and you asked. Your savings lived inside a small passbook, a physical ledger with inked entries recording each deposit and withdrawal. There were no multi-step logins, no pending notifications, no automated fraud filters deciding whether your own request was suspicious. You walked up to the counter, presented your book, the teller opened a drawer, and your balance could be placed in your hands the same day, often within the hour. If you wanted every last dollar, you got every last dollar. The risk was that the bank might run out of cash, not that it would deny you access on principle. The same was true of investing. Buying stocks did not mean owning a number buried in some unseen database. It meant receiving a physical certificate, an ornate piece of paper, with borders, signatures, and your name written on it. That document was proof of ownership in a company, something you could store in a safe or lockbox. If you wanted to sell, you had options. You could walk into a broker's office, hand over the certificate, and receive cash after a standard settlement period of a few days. Or you could find a buyer directly. There were no digital trading halts in the sense we know them today. No centralized switches that could flip and tell millions of investors, you may not sell right now. Markets could be chaotic, prices could collapse, but the mechanism between your decision and your ability to act on it was straightforward. That relative simplicity meant that in late 1929, those who sensed danger had genuine escape routes. They could liquidate their stocks and stand aside. They could empty their bank accounts and sit in cash or gold. Many didn't, because optimism was powerful, and the pressure to believe everything is fine is always strongest just before it isn't. But for a small minority, like that Manhattan businessman, the path from intuition to action was clear. There was no penalty for being early, no fee for changing your mind, no legal wall that said, not until you are old enough. When the crash hit in October 1929, the dividing line between survival and destruction wasn't a loading screen or a processing backlog. It was timing and psychology. Those who had already moved to cash or gold watched the storm from the sidelines. Those who believed the reassuring headlines, who took comfort in the loud voices telling them to stay calm, were wiped out when the bottom fell away. Banks failed not because they preemptively froze accounts, but because they honored withdrawal requests until the vault was drained. A bank run, brutal as it was, still acknowledged that depositors had a claim on their money. It was first come, first served, not access denied. Even the leverage that made 1929 so violent was transparent. If you bought stocks on margin, you knew the deal. Maybe 10% of your own cash, 90% borrowed. When prices fell, your broker called you. Either you posted more collateral or your stocks were sold to protect the lender. It was harsh and often devastating, but the rules were visible. You understood where you stood. No one pretended your account was safe while quietly embedding complex conditions that would only appear when the system was under maximum stress. Now hold that picture next to the world you live in today. Compare a passbook savings account to a modern retirement plan that locks your own contributions behind age requirements and penalty codes. Instead of a teller handing you cash, you have a portal that tells you what you own but punishes you for trying to touch it before a date chosen by legislators. Compare that physical stock certificate, which you could move or sell on your terms, to a digital brokerage account that can suddenly display warnings. Trading halted, redemption suspended, processing delay. The 1929 generation faced a merciless market, but they did not face a system structurally designed to keep them from exiting. We do. This didn't happen by accident. After the Great Depression, regulators didn't just try to prevent another crash, they tried to prevent the behaviors that made crashes visible. Bank runs, panicked selling, sudden shifts from risk to safety. These visible eruptions were treated not just as symptoms, but as causes. Over decades, reform after reform layered in mechanisms that limited how quickly ordinary people could pull their money out. The rhetoric was about stability, protection, and long-term discipline, but the effect was to turn your savings into something closer to a captive audience than a liquid reserve. Take the 401k. On paper, it was introduced in the late 1970s as a tax-advantaged way to save for retirement, a kind of reward for being responsible. In practice, it created a massive pool of capital, trillions of dollars, that workers are strongly discouraged from accessing for anything other than old age. The message is subtle but firm. This money is yours, but not really. It exists in a kind of legal quarantine. Try to pull it early, and the system bites back with taxes and penalties that can strip away a third or more of what you withdraw. The pain is designed. It teaches you that even when danger feels close, the rational thing is to stay in. And then there is time, the most invisible lock. When you request a withdrawal from a retirement plan, there is no equivalent of sliding a passbook across a counter and watching someone count bills. There is a form, a review, a processing period. 7 to 10 business days, if nothing unusual is happening. During crises, those timelines stretch. In 2008, when markets seized and fear spiked, some providers simply paused distributions, citing administrative review or valuation uncertainty. People logged in and saw their balance, but clicking withdraw produced only a message, temporarily unavailable. Their money existed, but only as numbers on a screen that could not be converted into rent, groceries, or a plane ticket out of town. Banking has followed a similar path. Officially, you can still walk into a branch and request cash, but if the amount crosses certain thresholds, the relationship changes. Withdraw more than a modest sum, and you trigger reports to government agencies. Try to take out $10,000 or more in cash, and your bank may not just file paperwork, it may decide your request is suspicious and delay it while someone reviews your activity. ATMs, the supposed pinnacle of convenience, cap you at a few $100s a day. A checking balance of $50,000 can be real enough to calculate interest on, but not real enough to access in a single move. To extract it all in cash could take weeks of repeated visits, assuming no one flags your behavior along the way. All of this is framed as anti-money laundering policy, fraud prevention, or responsible oversight. To some extent, those goals are real, but the side effect, and increasingly the core feature, is that the modern saver cannot replicate what that Manhattan businessman did in 1929. You cannot simply wake up one morning, read the signs, and decide to move your wealth out of the system before the stampede. Your path is littered with friction by design. And the deepest traps are not even in your checking account or your 401k, but in the investment vehicles that have become the default home for middle-class savings: mutual funds, ETFs, real estate funds, private investment pools. These instruments promise daily liquidity, diversification, and professional management. What they actually offer, in calm times, is the illusion that you can get out whenever you want. Under stress, that illusion is tested, and in more and more cases, it breaks. We've already seen glimpses of this. Exchange-traded funds trading far below the value of the assets they supposedly represent. Mutual funds invoking clauses that allow them to suspend redemptions when too many investors head for the door. Real estate trusts telling participants that withdrawals are temporarily paused while managers stabilize the portfolio. Each case is sold as necessary, prudent, even protective. But for the person trying to get their money out, the reality is simple. The exit is blocked just when the desire to leave is strongest. We are the first generation to live inside a system where almost every major savings channel, retirement accounts, bank deposits, investment funds, contains explicit or implicit mechanisms to slow or stop mass exit. The gates are already built. The question is, what happens when something big enough hits them all at once? That answer lies not just in the traps themselves, but in the unprecedented amount of leverage, speed, and fragility sitting underneath the surface, waiting for a trigger. The irony is that none of these traps would matter much in a world with little debt, slow markets, and modest speculation. A system that forces you to think long-term can be a blessing when the underlying machine is stable. But that is not the world we are in. The locks were installed during decades when leverage quietly multiplied, trading sped up, and central banks used every tool they had just to keep the illusion of calm intact. The architecture that once looked like a safety net now sits on top of a powder keg. In 1929, leverage was raw and obvious. You put 10% down, borrowed the other 90%, and tried to ride the boom. It was naive, but it was visible. Regulators looked at the wreckage of the Great Depression and concluded that forcing higher margin requirements would solve the problem. Raise the down payment to 50%. Limit how much brokers can lend, and you limit the damage. On paper, that made sense. On paper, the system today looks safer. But the real leverage didn't disappear. It moved into shadows that most people never see. Now it hides inside derivatives, structured products, collateral chains, private equity funds, and credit instruments with names most savers will never hear. A single dollar of capital can support $20, $30, even $50 of exposure when it is stacked and rehypothecated through layers of contracts. That means when something breaks, it doesn't unwind gently over months like in 1929. It can cascade in hours. The selling is no longer driven by human beings on a crowded trading floor shouting and waving tickets. It is driven by algorithms executing code that doesn't panic, doesn't hesitate, and doesn't sleep. Today, as much as 70% of trading volume in major markets comes from automated strategies. These systems scan volatility, price trends, correlations, and order flow in microseconds. They are programmed with rules. Sell if volatility spikes, sell if prices drop below certain levels, sell if too many assets start moving together. Each algorithm is trying to protect itself, but together they behave like a stampede. When one system starts unloading, it triggers the signals of the others. Selling begets more selling, and the market can fall faster than any human can think, let alone react. We got a preview of this in March 2020. The S&P 500 fell over 30% in just 23 days, the fastest drop of that magnitude in history. Circuit breakers, mechanisms designed to halt trading when declines are too steep, were tripped multiple times. In theory, these halts exist to give cooler heads time to evaluate. In practice, they compressed panic into tighter windows. The selling didn't stop. It simply bunched up, creating even more violent moves when trading resumed. Now imagine that same mechanical panic running through markets when the traps we've talked about are fully engaged. You watch your retirement account fall 20%, then 30% in a matter of days. You decide you've had enough. Rationally or irrationally, you'd rather lock in a loss than risk losing everything. You submit a withdrawal from your 401k, fully aware that you will pay taxes and penalties. You are willing to swallow the pain because survival feels more important than efficiency. Yet your request does not convert into cash. It sits in a queue while markets continue to slide. Another 10% disappears, then another. By the time your distribution is finally approved, your original $200,000 may be $100,000 on the screen. Then the penalty structure takes its cut. After taxes and early withdrawal charges, you might walk away with $60,000 in the bank. 70% of your supposed nest egg is gone, even though you tried to act. That is the benign version. The darker version is that, during peak stress, administrators activate extraordinary circumstances clauses baked into plan documents. They suspend all redemptions temporarily. Your balance changes every day, but your ability to act stays stuck on pending. You are watching a house burn through a window you cannot open. Banking, for all its obvious advances, carries its own kind of fragility. In 1929, banks collapsed because they lent too aggressively and held too little in reserve. Today, regulations require higher capital buffers and more oversight. On the surface, the system looks stronger, but its dependence on digital infrastructure creates a new vulnerability. Payments don't move as sacks of cash on trucks. They move through Fedwire, ACH, SWIFT, and other networks. These systems have limits and fail-safes. They can be throttled, slowed, or temporarily halted in the name of security or stability. We saw a small crack in this facade in September 2019, long before any global pandemic. The overnight repo market, a plumbing system banks use to borrow short-term cash, suddenly seized up. Rates spiked from around 2% to nearly 10% in a single day. The Federal Reserve had to inject tens of billions of dollars just to keep short-term funding from snapping. And that was during a period that was officially described as stable and healthy. If that kind of stress appears in supposedly calm waters, what happens in a true storm? We saw another preview in March 2023 with the collapse of Silicon Valley Bank. In the old world, a bank run meant people standing in line. In this one, depositors moved billions with taps on a phone. Rumors spread on social media. CFOs sent messages to move funds now. And in roughly a day and a half, a regional bank went from functioning institution to seized asset. Customers with deposits above the insured limit suddenly had money frozen. For several days, they lived in financial limbo, unable to access funds they needed to pay employees and suppliers. They didn't just face the risk of losing money, they faced the risk of being locked out long enough for their business to die. Scale that event up. The FDIC, the backstop designed to reassure depositors, has a finite pool of resources, tiny compared to the total volume of deposits in the system. Its fund can handle a handful of failures, maybe more if they are managed carefully. It cannot smoothly absorb a wave of simultaneous collapses. The numbers simply don't work. This is not conspiracy, it is arithmetic. Layer on top of that the position of central banks and governments as we approach the middle of the 2020s. In previous crises, the Federal Reserve could slash interest rates aggressively from high levels, flood the system with liquidity, and rely on governments with relatively cleaner balance sheets to deploy stimulus. Today, interest rates are already elevated after an inflation fight. The Fed's balance sheet is bloated from years of quantitative easing, and government debt sits in the tens of trillions. The tools that once shocked the heart back into rhythm have been used repeatedly. The patient is saturated. This is why a potential 2026 collapse is so dangerous. The speed of selling is faster, the leverage buried in the system is larger, and the official firepower left to fight the flames is weaker. In 1929, at least, people who saw the danger could try to escape. The crash unfolded over years as the economy ground lower. Today, the fall could happen in compressed, violent waves, while the majority of savers are locked inside structures that penalize exit, delay access, or suspend it altogether. And yet, if you only watched television or read cheerful market commentary, you'd barely know any of this is happening. The message to ordinary investors is the same as always. Stay the course, think long-term, ignore volatility, trust the system. But if you want to know how close we are to the edge, you don't listen to what the crowd is told. You watch what the people closest to the fire are doing with their own money. If you really want to know where we are in the story, you don't look at the slogans sold to the public. You look at what the people closest to the numbers are doing with their own chips. In the final months of 2024, something quiet but telling began to show up in the data. Corporate insiders, CEOs, CFOs, board members started selling shares in their own companies at a pace not seen since the last great wave of speculation. Around $16 billion worth of insider stock sales in a single quarter, roughly 4 times their usual rhythm. These aren't day traders chasing headlines. These are the people who sit in closed-door meetings, who see order books, profit margins, and refinancing schedules before any of it hits an earnings call. When they exercise options and dump shares into a rising market, they're not usually positioning for a modest 10% correction. They're stepping aside from something they expect to be larger and longer. Zoom out further, and the pattern becomes even clearer. Sovereign wealth funds, the giant, slow-moving pools of capital managed on behalf of nations, began to lean away from the very assets they once embraced. Allocations to U.S. equities were trimmed back. Exposure to volatile growth stories was reduced. At the same time, you could see them quietly increasing positions in old, unfashionable refuges, gold, cash-like instruments, short-term government bonds, energy, and raw materials. Norway's fund, Abu Dhabi's, and others with multi-decade horizons all accepted lower expected returns in exchange for sturdier ground. These are not institutions that panic on rumors. Their job is to survive generations. When they sacrifice upside voluntarily, it's because their models are flashing risks large enough to outweigh the political pain of missing the last leg of the party. Meanwhile, the market that is supposed to be the safest in the world, U.S. Treasuries, started to show stress fractures. In late 2024, trading conditions in the Treasury market began to look eerily similar to pre-crisis periods. Bid-ask spreads widening, dealers stepping back, large orders pushing yields around far more than they should in a truly deep liquid market. It's like watching the foundation of a skyscraper tremble while the penthouse is hosting a champagne reception. When the very instrument the world uses as risk-free collateral begins to feel illiquid, it means that even the professional buyers are nervous about what might happen if they get stuck holding too much at the wrong time. And yet, against this backdrop of insider selling, sovereign repositioning, and fragile bond markets, the official narrative remains almost soothing in its repetition. The economy, we're told, is fundamentally strong. Corporate earnings are resilient. Innovation, especially artificial intelligence, justifies valuations that would have looked insane to every previous generation. The same chorus sings the same song. This time is different. The numbers, however, tell a less comforting story. Measures like the Shiller price-to-earnings ratio sit around levels that exceeded both 1929 and the dot-com peak. The yield curve, the spread between short-term and long-term interest rates, has been inverted for years, a signal that has preceded every recession in modern history. Normally, downturns follow that inversion within a year or two. We are far beyond that window, in uncharted territory where the pressure just keeps building. This is what makes the moment so uniquely dangerous. The warning lights are on, brighter than they've been in decades. The people closest to the machinery are quietly reducing risk. The underlying math of valuations, debt loads, and growth expectations looks stretched to breaking. And at the same time, the system containing ordinary people's savings has never been more locked down. In 1929, the trap was emotional. Greed, denial, and the fear of looking foolish by stepping aside too early. Today, the trap is both emotional and structural. The average worker is told to stay invested, think long-term, and ignore scares, while their money is channeled into penalty-locked retirement plans and funds that can legally restrict or suspend redemptions when panic hits. They are being used as exit liquidity, the last buyers holding the bag when those with more information quietly file out. History doesn't copy and paste, but it rhymes with obsessive consistency. Before 1929, people convinced themselves that industrial technology had created a new, permanent plateau of prosperity. Before 2000, they believed the internet had rewritten the rules of valuation. Before 2008, they trusted that financial engineering had made massive piles of debt safe. In each cycle, a new story emerges to explain why old constraints no longer apply. In our era, that story is artificial intelligence, data, and central bank mastery. We are told that risk has been tamed, that algorithms can optimize everything, that policymakers have developed tools to prevent real pain. Underneath the new language, it is the same old thought. This time, we're smarter than those who came before. But crashes are not simply about numbers going down. They are about illusions being stripped away. The illusion today is not just that markets always recover if you wait long enough, but that you will be allowed to wait in a position you chose. The deeper illusion is that the money you see on a screen is always yours in any circumstance. For your grandparents, ownership meant the ability to walk into a building and walk out with value in hand, the same afternoon. For you, ownership often means having a username and password to an account where rules can change precisely when you most need them to stay the same. Return one last time to that businessman in September 1929. He wasn't a prophet. He didn't run complex models or read secret memos. He simply felt that something was wrong and, crucially, lived in a system that allowed him to act on that feeling without asking permission. He placed his passbook on a counter, received his savings in cash, and stepped outside before the crowd realized the party was over. His survival wasn't guaranteed. The decade ahead was still brutal. But he had one priceless advantage: freedom of movement. You, standing in 2026, do not have that same freedom in the same way. You cannot empty a retirement plan in an afternoon without triggering penalties that gut your balance and delays that expose you to the very collapse you are trying to avoid. You cannot pull large sums of cash from a bank with questions, paperwork, and potentially long waits. You cannot assume that the funds you think you can redeem at any time will behave the same under stress as they do in calm. The exits that once saved people like him have been narrowed, gated, and wired with alarms. Yet that does not mean you are doomed to be a passive victim. It means your choices must happen earlier, further away from the cliff's edge. You can decide how much of your future savings you feed into penalty-locked, slow-moving accounts and how much you keep in forms you can actually touch when needed. You can pay attention to the behavior of insiders, institutions, and markets instead of only listening to their words. You can recognize that tax advantages are not a gift if they come with chains attached, and that giving up a little efficiency today may buy you flexibility tomorrow. Preparation in this world is not a last-minute dash for the exit. It is a quiet, deliberate repositioning before anyone else believes leaving is necessary. Every generation stands at this fork, convinced in some way that they are exceptional, that the old stories of boom and bust don't apply to them. Most choose comfort. They believe the reassuring narratives, keep feeding their money into structures they don't fully understand, and assume that someone, somewhere, will make sure it all works out. A smaller group chooses discomfort. They study history, notice patterns, and are willing to look foolish or pessimistic while everyone else celebrates. They are not always right about timing, but they rarely end up trapped with no options. The traps are built. The warnings are visible. The people closest to the fire are already inching toward the doors, even as they go on camera to tell you everything is fine. The question is not whether markets will fall again. That is guaranteed by the logic of human behavior and leverage. The question is where you will be when the fall comes. Standing in line outside a bank that cannot honor its promises? Staring at an online account that shows your wealth shrinking while a message says transaction pending or redemptions temporarily suspended? Or positioned, however imperfectly, outside the cage before the lock slams shut? Your grandfather's generation could grab their money and run. You can't do that in the same way anymore. But you can still choose whether to live as if the gates will always stay open or to act as if you know they might not. When the moment arrives, it will not look like a dramatic movie scene. It will look like screens freezing, delays stretching, polite explanations about procedures and protections, while numbers you thought were solid evaporate line by line. By then, your decisions will already have been made. The timeline is narrowing. The system will not send you an invitation to leave before everyone else wakes up. You either recognize the pattern now and adjust while you still can, or you trust that this time really is different and step forward with the crowd. History is watching which choice you make.